Good afternoon, Mr. and Mrs. Kessler. How's everything going? Very good. Well, I'm glad to hear that. Thank you for taking the time today to go over your comprehensive financial plan. We have a lot to cover today, so just want to check in. Are there any things that you want us to cover right away or prioritize in this meeting? Okay, that's fine. We can go through at any point. If you have any questions, please feel free to stop me. I'm happy to explain things further. But first, how was your vacation? That's excellent. Oh, I'm really happy that you guys got a chance to enjoy and relax during the tail end of summer here. So, very good. So we can dive a little bit deeper and get into the weeds here a little bit on your plan. So the purpose of this meeting, again, is to review all the individual aspects of your plan. We're going to look at the investments, the insurance, estate planning, retirement, taxes, all the different aspects, and we'll cover those one at a time. We're also going to address the goals that you had listed, so reducing your estate and gift tax liability and your estate plan in general. We're going to review your insurance coverage, discuss the implications of long-term care. We're going to see what we can do to reduce your personal income taxes, and we're going to review the investments. Where I always like to start is to just cover some of the assumptions that we're taking this plan. So the risk-free rate is basically the rate you could earn on treasury bills, very safe investments, things like that. We're assuming 3%. We're assuming inflation is 2.75%. The S&P 500 or the market return is 11% with a standard deviation of 12%, which just refers to how much variation there is in the stock market from year to year. We're assuming that you have a high tolerance for risk and a high capacity for risk because of your high liquidity, low income need, and low levels of debt. That's something we'll dive a little bit deeper into as we get into the document here. And we're also finally going to assume that you're in the 37% tax bracket. All that makes sense? Any questions on any of that, or does anything jump out to you from that list? Okay, great. So we can start with your financial health, which overall is in good shape. You have a strong net worth of $13.7 million, $13,707,000 and some change. And you have a net disposable income for the year of $1,026,000 and some change. Obviously, this is a very strong net worth. You have some great assets, and you guys have done an amazing job of saving, building up your nest egg, and we're so happy to see that you're going to start to be able to enjoy these as you transition into retirement. Right now, you have a cash position of about $746,000, which is based on the spending that you gave us, 15.54 months of expenses. This is considered overfunded. The general rule for cash savings is between 3 to 6 months. Obviously, right now you're about 5 times that. This is not a bad position to be in. You have plenty of room for other goals, things like that. But one thing to consider is that this cash could be invested to earn a better yield. And the other factor is some of this cash is not covered by FDIC insurance. So FDIC is the government agency that insures deposits in banks and steps in when there's issues with banks like we saw in 2022 and 2023. Right now, 423,000 of the 746 is not covered by FDIC, and that's something we want to take a look at. There are a couple ways to handle this. The first is to balance the deposits between the registrations. So each depositor at each institution gets $250,000 worth of coverage. Now, because most of the cash assets are in John's name at Central Savings Bank, we want to balance between John and Mary. If you want to keep your banking there, you can establish a revocable trust, which acts as an extension of you two. That can get another $250,000 worth of coverage. And then 250 times 3 is 750. That would cover all of your cash. So the next step would be either establish a trust, and we'll touch on that in the estate planning section, or you can open an account at a new institution and get a fresh $250,000 at that institution for one of you. But at the very least, you should balance those CDs between both you, John, and you, Mary. Any questions on that? And just to tie back, when I say overfunded for the cash, again, it's a good position to be in, but you're perhaps leaving some yield on the table, and that's something we want to take a look at. Any questions? Very good. So your debt ratio, which is a ratio of your assets to your debt, is extremely strong. We don't see much reason to pay off the mortgage on the vacation home. There's very little debt on it. It's very affordable overall. The ratio of your income that you pay towards housing is just about 3%. That is well below the benchmark of 35%. Excuse me, that's well below the benchmark. So there's of 28% is what I meant to say. And it indicates that you have very affordable housing costs. And you could pay off the mortgage, you could save a little bit of interest by doing that, but that's more of a convenience thing. It's not going to make or break your picture in any way. Something to keep in mind. But other than some month-to-month credit card costs, you have no other debt. You have an extremely strong debt ratio. The benchmark's usually 1.0 is considered healthy. Anything above that is good. Anything below that is considered bad. Yours is 30.06. So you're 30 times better than the benchmark, which is a great position to be in. And you guys should feel very proud. The last thing I want to touch on is the net disposable income. Of course, some of this is from the down payment of the note receivable that you're going to from the sale of the business. Congratulations again, John, by the way, for that. But also, of course, the substantial payments. So this year is going to look a little bit higher than next year, for example, but we want to have a plan for some of that excess income, put this into a non-qualified savings account, things like that, just to make sure that those funds are generating the yield that they should be to help achieve your goals. That's a summary of your financial health. Do you have any questions on that? Very good. Nice and easy. Let's keep it going. Next is risk management or insurance. The first place that we always like to look is the insurance on your primary residence. So right now, your coverage on your primary residence is underinsured, and the coverage should be increased. So to put it in context, if you had a $100,000 loss, that would mean that you would have to come out of pocket with $37,000. And the way this is calculated is you take the value of the building, the replacement cost of the building, excluding the land. So say your house is worth $800,000 for easy numbers, and the building's worth $600,000. The land is worth $200,000. That's not going to get destroyed. That's going to stay there. But the $600,000 building, you want that to be covered up to around 80% or greater of that to be covered. Right now, your coverage is less than that, and we do recommend increasing the coverage to $620,000 from the $400,000, which is just about 52% of the building's replacement cost. So we don't want to have you come out of pocket for a loss. That's something nobody wants to deal with. So we definitely recommend increasing the coverage to $620,000. From there, $620,000 would be the minimum. You could go a little bit higher so you don't have to rewrite the policy in a few years. But that's where you would need to be to make sure that a loss of $100,000 would be covered. All that makes sense? Very good. Your vacation home, coverage is sufficient on that. We're going to check in on that as the years go by, make sure that it stays good, and will need to be adjusted in the future, but not for quite some time. Disability insurance, you guys are both retired, you don't have earned income, this doesn't apply. We just want to mention that, just make sure that you guys know that we are considering all the factors. For auto insurance, one thing we want to look at is the liability coverage. So right now you have $500,000, which is great, but of course your assets are worth a lot more than $500,000. Ideally, you would have an umbrella insurance policy, which covers liability over the $500,000 that your auto insurance provides. And these policies tend to be fairly inexpensive for the dollar amount of coverage. However, with your substantial assets, things do get a little bit more complicated. So ideally, you would have a $15 million umbrella insurance coverage. Now, that may be difficult to get. Not all carriers offer this without complicated underwriting, things like that. So we recommend contacting your agent, and we're happy to be on the phone and help out with this conversation. See what the max coverage you can get is to cover all your assets without having to go through all that underwriting. And then if a special policy is needed, we're going to consider some other estate planning tactics or asset protection tactics to avoid any liability, especially considering the vacation home, things like that in the future. Any questions there? Okay. Finally, in insurance is life insurance. Considering that you're retired, you have very little debt, and we'll dive deeper into this, but you aren't expected to owe any estate taxes at this time. Life insurance isn't entirely necessary. So you've been paying for these policies for quite some time. You've accumulated quite a large cash value. There is value in the policies. We're not saying to get rid of them right away, but a couple things that we do want to do is we want to gather some illustrations, which are basically projections of the policies, and say, what are the options if you stop paying premiums out of pocket and pull from the cash value instead? Or what's the maximum income you can take to help supplement your lifestyle? We want to see what the options are. You could also decrease the death benefit to bring down the premium costs. There are some restrictions with that, but if you decrease the death benefit, you're paying for less insurance, and it could make the policies a little bit more sustainable as retirement goes on, especially once that the note receivable payment slows down. Any questions there? Okay. As for your investments, most of your investments are in non-qualified assets. Now, that means taxable regular brokerage account. A lot of these assets came from the sale of the business too. And the great news about that is we can control the taxation to some degree. You pay taxes on capital gains, interest, and dividends that are generated from the account, but you can take assets out, and if there is no capital gain, then you could take as much out as you want. We can keep track of that, and we'll be very mindful of capital gains going forward. This being said, the portfolio does need to be rebalanced, and it should be diversified. We want to get it into a portfolio that aligns with your risk tolerance, your goals, with your capacity for risk. So right now, the portfolio is really concentrated. There are some assets that have performed really well, but there's one position in the stock portfolio in particular that has lost a significant amount of its value. There's only, 4 funds in each in the stock portfolio, and we really want to make sure that you get into a diverse mix of funds that cross many different sectors to balance out those returns a little bit more. Also, the mutual fund portfolio has some bond holdings that are kicking off income that is taxed at your income tax bracket. This is something that we want to take a look at. We want to change those to municipal bond funds. Those will kick off income that it's income tax free to you. It's exempt from both federal taxes and state taxes, which is a really good position and a really good way to get you some income. They don't make sense for everybody, but considering your high tax bracket, they definitely make sense in this case. This is especially true because you're also subject to the net investment income tax, which is a extra tax on investment income since your AGI, or adjusted gross income, for the year is over $250,000. Going through the rest of the accounts, John's accounts should be invested in a diverse mix of assets as opposed to the one fund that's in there. It is a broad-based fund, but we would like to see more sector exposure and be able to really spread it out and bring it in line with your risk tolerance. And finally, Mary's 403B. It's an okay choice, the target date fund that's in there, but these do need to be monitored. This fund, it's one holding, but underneath it holds a bunch of different funds. And as time goes on, they get gradually more and more conservative. They can be a great set it and forget it choice for a lot of people, and they're really popular in retirement fund and retirement accounts. However, there comes a point where a more custom portfolio may make more sense, or one that we can control the individual funds. There also can be high expense ratios in there. We couldn't tell from the statement that we received what the expense ratio was, but that's something we can take a look at and see if we can build a portfolio with a lower expense ratio. So overall, we want to rebalance the accounts, and we want to bring them in line with roughly a 70-30 or an 80-20 portfolio. Now, what that means is the first number refers to the exposure to equities or stocks, and the second to fixed income. There's a lot of rules of thumb out there based on age, based on stage of life, what you may have going on. You could have heard of the 60-40 portfolio, or your age, 100 minus your age. That should be exposure to stocks. These are rules of thumb, but they're not universal. You have very high liquidity, you have very low debt, and you don't need to touch the portfolio right now. So you have a high capacity for risk. And what that means is, if you needed to tap these accounts on a monthly basis to provide the income that you need, we would be more conservative, and we would recommend maybe a 60-40 portfolio. But considering that these are going to be left to grow for a long time, 80-20 is where we're landing in terms of a recommendation to be a little bit more aggressive. This will be brought down over time as, there may be more need to pull from the portfolio, but for now, that seems like a good choice. One last thing I want to mention is in the non-qualified or the taxable accounts, there are two things I want to call out. Number one, over that whole account, if we rebalance it now, there would be a capital loss over the entire account. So what that means is to totally sell out of everything and buy all new assets, that would not generate any taxes for you. It would actually generate a loss that you can use to offset income this year and carried forward for a couple years, or offset gains in other parts of the portfolio. So it would not be a very large taxable event. The other thing is, if these non-qualified accounts are allowed to grow into the future, obviously you want to leave some assets to your children. They would receive what's called a step up in basis on those assets, which is a very tax efficient way for them to inherit. So if you buy stock at 10, it goes to 15, and you just gifted it to your children while they're alive, they would pay taxes on the $5 gain if they sold it. But if instead you pass away and they inherit the stock at $15, their new basis, where they measure the gain from, is 15. So let's say pass away, they inherit the assets, and a week later, stock hasn't moved, they decide to sell, there would be very little taxes for the kids, which is a great advantage. Any questions on the investments overall? Very good. We'll put together a proposal with all the recommended changes, which account will hold each individual holding. There's some logic there to, the retirement accounts should hold some income assets because all the all the funds that come out of that will be taxed at income anyways. We can put some growth in the taxable, and hopefully those can be left to grow and the kids can receive a step up in basis. There'll be more information than that in the proposal, but we just wanted to let you know. Does that all sound good? Excellent. Next up is retirement. We know that this isn't a huge concern for you considering the note receivable payment. One thing we want to consider is what's going to happen once that note receivable payment goes away. Right now, the payments are high. They're going to fund your lifestyle. You don't need to pull from the portfolio. But, 7 years of payments, it's a long time, but John, you'll be 78, and Mary, you'll be 75. There's still going to be a long time there where income is going to be needed, and it may have to come from the portfolio. All that being said, our projections look like that should be fine. You have nothing to worry about, but it's something we're going to keep an eye on as time goes on to make sure that things are looking good. And as that 7-year mark approaches, as we mentioned in the investments, we can pull back some of the risk on the portfolio to prepare for some of that income to come out. All that makes sense? Very good. We don't want to spend too much time on that because we know it's not top of mind for you. For taxes, you are in a very high marginal tax bracket. You're in the highest, in fact. So the portfolio's got to be managed very carefully. We mentioned the net investment income tax, which is the extra tax on capital gains. And we mentioned municipal bonds, which are a way to provide tax-free income to you if needed. These are some features that we want to avoid the net investment income tax, and we want to use tax-free or tax-efficient vehicles whenever we can. So in the stock account and the mutual fund account, we want to look at what are called ETFs, or exchange-traded funds, or mutual funds, which are both vehicles that you can buy a single ticker, basically a single holding, but get a huge amount of diversification at once with a modest small dollar amount. If you're careful and you can find some passive investments, you can find some that don't have a lot of turnover, that don't kick off capital gains to you on an annual basis. They're sort of buy and hold funds. Those should take the priority for you so you're not paying any excess taxes. That's something that's going to be a feature that's built into the investments to keep your taxes as low as possible. The other thing we'll do on an ongoing basis is harvest any losses that are available in the account. The market does go up and down, and every now and again, one particular holding may have a loss in it that we can use to offset gains in another part of the portfolio. So one thing we'll look at is harvesting those losses as time goes on to reallocate in a tax-neutral way. You mentioned wanting to grow the 401k and the 403b tax-free. This isn't really possible. And the reason for that is at your age 75, you're going to be subject to something called required minimum distributions. Basically, what this means is you were deferring funds into the 401k and 403b at the highest marginal tax bracket. You were putting those funds away tax-free or tax-deferred. The accounts were growing. And to put it bluntly, the IRS wants their money. So they mandate that you take a certain percentage of the account out based on your life expectancy each year. And the funds that come out of that are subject to income tax rates. So it won't be, the growth inside of the accounts will be tax-free, but any withdrawals from that will be taxed. So we're going to do what we can to take the minimum from the RMDs, but it's not entirely possible to grow them and be able to take the funds out tax-free, if that makes sense. One option is you have been giving to charity in the past. You can use what's called a qualified charitable distribution. This applies to you, John, but not yet for you, Mary. You have to be at least 70 and 1/2 years old. But this allows you to send funds from an IRA or 401k directly to a charity without having to pay the income tax on it. So as opposed to you take the funds out of the IRA and then write a check to the charity, you can send it directly to them, satisfy your RMD without having to pay the income taxes on it, which keeps your income tax down. So that's one solution. Your RMDs may be higher or lower than how much you want to give to charity in a specific year, and this is something we can talk about year to year. One thing you can do is also list a charity as a beneficiary of the accounts. You would get a deduction from your estate at that stage. It's a little bit different, but if the kids receive a IRA, 401k, all the income that they pull from that would be taxable as income as well. And there is a 10-year withdrawal rule where they have to pull the entire account balance within 10 years, which can provide some tax issues for the kids down the line. So giving to charity, doing those things, these are all things that we're going to keep an eye on. Any questions on any of that so far? Just a couple more tax things and then we'll get to estate planning. Okay. So the last thing is, if you don't want to do the QCD, if you'd rather receive the money first, another thing you could consider is what's called a donor advised fund. These allow you to take a bunch of charitable contributions and put them into this fund, and you can take a deduction for many years of charitable giving into 1 year. These can be really powerful. So right now you're taking the standard deduction from the taxes, as most people do. Most people don't have enough to itemize and get over the standard deduction. But a donor advised fund may provide the ability for you to do that. If you give to a qualified organization, you can deduct up to 60% of your AGI while giving to charity. Of course, that's a very high number for you. We're not suggesting that, but you could take that charitable deduction from your income to help keep taxes down. This is something we can review year to year, depending on your charitable goals. Does that make sense? Very good. So we're getting towards the end here. Finally, estate planning. So as of now, you guys have a will, but we do recommend, and in short order, that you meet with an estate planning attorney to establish a very robust estate plan. So the documents that we consider essential are a durable power of attorney, which allows people to act on your behalf in the event that you get incapacitated. A living will, which can help dictate your healthcare wishes, what treatments you may or may not want to receive. The healthcare proxy, which allows somebody to act and make healthcare decisions for you. The HIPAA release form, which allows your healthcare proxy to request medical records. Your wills, last will and testament, as you guys are used to, and revocable trusts, and maybe irrevocable life insurance trusts. So, very quick lesson on trusts. There's two types. Number one is a revocable trust. This can hold assets that don't have beneficiary designations. Think of things like the house and your cars and some of other individual titled assets. If the trust owns these, they don't go through probate, which can lower your probate cost overall, and you can dictate exactly who those go to. And you get the benefit of privacy from the trust document, which is really beneficial. We definitely think you should establish a revocable trust for many of these assets. And you could also open a bank account and move some of the cash at Central Savings Bank to get that FDIC insurance. These are very popular. Lots of people use them, and they can provide lower the probate costs and generate that privacy, which is really, really great. Make sure that the assets go where you want them to go. The second thing is an irrevocable trust. This is basically like creating a legal person that you can give assets to. This can own things, but they no longer belong to you. The reason we may consider one of these is to hold the life insurance policies. So if you gifted these policies into the irrevocable trust, and you could create and say, John, your policy, Mary could be the beneficiary, and vice versa, these policies, the proceeds from the death benefit would not be includable in your estate, which can make a significant difference if these assets do grow over time. Right now, you're not expected to have any estate tax issues if you were to pass away tomorrow, God forbid. However, if the portfolio does really well over the next 25 years, that could change. And of course, the estate tax laws could change. So one easy thing that can be done is to move the life insurance policies into an irrevocable life insurance trust to remove those from your estate. Does that make sense? Hopefully it does. There's a lot of moving parts, and again, we're happy to be part of any conversations with an attorney. But we definitely recommend establishing those main documents and talking through the pros and cons of each of these trusts. As of now, while you don't have an estate tax issue, probate expenses could add up. You have a few assets that don't have beneficiary designations, like Mary's 403B, for example, and the stock and the mutual fund account. These would go through probate. They add to costs. Probate is public. It can be dragged out for a long time. We want to do what we can to reduce that. So also want to add them beneficiaries to your bank accounts and CDs, stock, mutual fund, and Mary's 403B. Those are the four that we want to take a look at. And finally, for the durable power of attorney, which is one of the estate planning documents that a lawyer can help draft up for you, you want to check with your banks and your financial institutions. Sometimes they have their own powers of attorney that they want to use, that they want someone to use. It's a good idea to check with them, see what they have, see what they recommend. And I would have those filled out and on file. There's a lot of information here. We don't want to go too long and overwhelm you. But again, when planning with an attorney, we're happy to be part of the conversation and help you understand the pros and cons and how it fits into your financial picture. Any questions on estate planning? Very good. So the last thing here, super quick, we just want to discuss an action plan. What do we need to do and when? So the first thing is the immediate items. We would ideally like you to have these done within 30 days. So the first is call an estate planning attorney, draft up those documents, the power of attorney, healthcare proxy, living will, HIPAA release form, and revocable trust, maybe an irrevocable life insurance trust. Check over property titles, see what we can do to protect assets and limit the probate costs. The second immediate item would be to update your homeowner's insurance on your primary residence. Again, the minimum we want to see that at is $620,000, but you could go all the way up to the full replacement cost, so you'd be good for a few years. We're happy to be a part of that conversation with your insurance broker if you like. Also, we want to see an umbrella liability insurance of around $15 million. Or whatever the maximum available is in the meantime to protect your liabilities. So call an estate planning attorney and call your insurance broker and make these recommended changes. Those we want to see done in the next 30 days. The next are the short-term goals. So the next 3 to 6 months, we would love to help reallocate the investments, sell the underperforming concentrated stock positions, take advantage of that capital loss, and reallocate the portfolio according to your risk tolerance, your capacity for risk, and your goals. We want to make it tax efficient, get those municipal bonds and those tax efficient ETFs in there. that goes hand in hand with some of the other tax items that we want to talk about, like the donor advised fund, maybe giving to charity, qualified charitable distributions. Those are some things we would want to talk about over the next 3 to 6 months. Any questions on that? Very good. And then slightly longer term, 6 to 12 months, but still items we want to handle is reallocate the excess cash. So if you want to invest those, add them to the taxable accounts, that would be great. Or at the very least, we want to reallocate the accounts to make sure that you're within FDIC limits, to make sure those funds are covered. And then down the line, we want to take a look at that retirement cash flow, start to talk about what it would look like if that note receivable went away. And then going into the future, we're going to review this plan annually, track your progress, adjust strategies. We like to consider financial planning like a GPS, right? You know the route when you set off, but every now and again you have to, stop and go a different way, or you get a detour, and we're the GPS that's going to help guide you back towards where you need to go. So this is an ongoing process. We're not going to give you this plan and say, hey, good luck, I hope it all works out. That's not our goal. We want to make sure that we keep those taxes low, make sure your estate is well cared for, grow the accounts as much as possible in a tax efficient manner. So those are really the main things, the action plan. This is all in the planning document that we provided to you, when you came in today, and feel free to review it. And if any questions pop up, please feel free to let us know. And the very last thing, I know you guys are looking into getting a new car. I know you're looking at about $40,000 for that. We feel that because the cash position's so well funded, that's a good place to pull the funds from before we can, it's quick, it's easy, you don't have to sell anything, move accounts, anything like that. We would say just take it from there. And we hope you enjoy. It's very exciting to get a new car. So we covered a lot today. I'm sure you guys are digesting it all, taking it all in. As questions come up, as you read through the document, please let us know. More than happy to expand, have another call. And you just let us know what you need. Very good. Well, we're happy we could help, and we look forward to talking to you soon. We have a couple of names for estate planning attorneys that we're going to send to you after this call. We work with these folks all the time. They're very helpful, very professional. We know they'll take care of you. So if you can give them a call, as soon as possible, that would be great. Excellent. Well, thank you very much, and thank you for your time. We really appreciate it, and we look forward to talking soon. All right. Bye-bye.